Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by CommercialAgentSuccess.com. This is incredible video training for commercial agents and brokers. I know because I created it. Now today we have a show that's fantastic. We have KC Conway here. He's the senior economist with CCIM Institute, and we're talking about the economy and the impact on real estate moving forward. So I'd like to ask you about some of the sectors and some brief comments on some of the sectors. So I guess everybody loves industrial, so we'll go there in a moment. But what do you think about retail? I mean, that's the one that people seem to be a lot of concern. There's a lot of headlines. What do you think?
Yeah, so, we hear the term retail apocalypse, and I'm not in that camp. And I'll give you a couple of good examples of where we're not in retail apocalypse. So, Prudential, their mall portfolio REIT group, recently reported in their second quarter that for the first time in all their mall portfolio, they don't have a single empty department store or big box store. They've released them, repurposed them, and not with another department store, but it could be a Top Golf, it could be something more experiential, it could have been subdivided. But that tells us that we're finding alternatives, we're finding adaptive reuse for retail. The second one is my friends at TREP, which do a good job tracking everything on securitization. They had a report they published in July on retail, and what they found was that the NOI per square foot of all the securitized retail loans is back to where it was in 2004 and 5. And again, they noted a lot of that is because of adaptive reuse, more experiential retail coming in and filling it. So for those that can look at the fundamentals of retail, look at those good in-town locations, look at what they can do in adaptive reuse, it's not a bad story. And we're seeing innovative new basic retail concepts. The PGA Superstore by one of Home Depot's co-founders here in Atlanta is having tremendous success, but it's part selling stuff and part experiential, even with daycare. Go to a new car dealership. They've got daycare, they've got Starbucks, they have all kinds of experiential retail going on there. Another one I'll give is I tout is Batteries Plus. Batteries Plus is opening about another 36 stores this year and next year. When your phone and your battery device goes, you don't have time to go online and hunt for it. You need to know where a store is and get up and running right away. So there are a lot of concepts beyond gyms or churches and I'm not about the fried chicken, but actually religious organizations that are going into retail and backfilling it. So look at that. So I'm not in the down camp on retail. I think it's reinventing itself. I think we've hit the bottom and we're really coming back out of a new type of retail.
Yeah, I have to stop by the battery store on the way home. My garage door opener's dead. I won't be able to get in my house, who knows where my house key is? We'll find that, right? Well, what about industrial? We teased it. What do you think there?
Yeah, so industrial, and there's two stories on industrial. So one is the big e-commerce fulfillment that's got all the equipment in there, and they're now going to like 40-foot clear and higher ceiling heights to do all the e-commerce fulfillment. Believe it or not, that's only about 10% of the transactions in the leases. The other 80 or 90% is, not all businesses need 30-foot clear, and they all don't need 500,000 square feet. So a lot of these older business parks that are in town, good location, are doing real well. A local guy, Sim Dowdy with King Industrial, they study that and have documented that, in markets like Atlanta and Dallas, as much as 80% of the transactions, leases and sales are to these smaller, older buildings where companies that have recovered that small business growth, it could be a plumbing contractor, a housing contractor, could be some sort of supplier, IT guy. They need 10,000 square feet or 15 or 20,000, maybe with a little bit of office space. So those that are kind of closer in, good interstate infrastructure are very healthy. So the industrial, I think, will continue. Don't overlook. I think the value add opportunity is that older, low clear ceiling height. We can't afford to build it. You can't get it zoned. The costs are off the roof. So look at replacement costs. So I think the story in industrial is you do a replacement cost analysis to realize when we've gone too far. Some of these new buildings, you're looking at $150, $200 a square foot or more to build.
Yeah, that's a good point. In fact, I'm about to bring to market a industrial complex. It's just like that. It's close in, Alpharetta, Atlanta, great location, and the rents are really under market. There's a lot of area to raise rents, and I think you're right. And there's a lot of these small businesses that that thrive in these buildings, and they stay for a very long time. Well, let's talk about office. A lot of changes there. What do you think?
Yeah, I think the model. I wrote a paper earlier this year about the Amazon HQ2 and where they were going to go and what that meant. And we've been dealing with the term densification in office for too long. And the millennials, when they hear it, they get upset because they think we're suggesting they have a smaller IQ, and it's not that. They just have a smaller cubicle. So we're moving from densification to, I really think, this co-working environment, and it's spilling over in industrial. We're now starting to see co-warehouses where companies are saying, you know what, if I don't have to tie up capital in terms of a lease and people and FF&E, and I can just co-work, share this thing, and I have my cloud server somewhere else, this is a pretty good business model. And there's something that's really behind it. It's called lease accounting. At the end of next year, lease accounting takes effect. And there's no grandfathering. Every company that has a long-term lease or lease has to put it clearly on its balance sheet. That could create some huge financial disruption in terms of credit ratings of major companies that have a lot of long-term leases. It also is going to serve as a disincentive for companies to be on long-term leases like we're accustomed to in office. So my forecast, my new wild forecast is, I'll get my red shoes out again, is that Amazon's HQ2 is not going to be in one city. I think that between now and the end of the year, they're exploring an option with someone, a co-sharing entity like a WeWork, to say, what if we had, you provide us with 10,000 offices across 5 cities in the eastern, southeastern United States where our IT, our sales, our engineering folks could travel to, and we'll provide a credit enhancement to that. You think that's crazy? There's already a loan proposal in process on something of that nature, of the size of an Amazon, to do a co-working. So I think Amazon HQ2 could be a virtual headquarters that totally disrupts the office world. And we're already seeing it when you see markets like Atlanta and New York, where WeWork is the single largest tenant.
Well, one of the interesting things about that, I believe, would be, hey, didn't the open floor plan, wasn't that designed or sold on that we can interact, that we get more done together, and if a company like that just spreads everybody out and they're working at home and they're working everywhere, what happened to that? I thought we all wanted to work together and get more done.
It's a great question, and they may all say, there's a great football game at Athens this weekend. Let's all have a co-sharing office in Athens on Friday so we can go to the game or something, right? Or over in Alabama. It's going to be interesting. The millennial workforce is going to completely redefine what we do in office space. It's already happening, and I don't think we're even in the first inning of what that means. But I think co-working, really pay attention to that, what that means. It's hoteling office space.
So your outlook then for office investment moving forward?
I think that unless you have a deal locked up with a tenant long-term, I think those long-term leases are going to get harder to come by, whether it's a bank or a law firm. If they're an SEC filing company, they're going to have to record that liability. And that 10, 20-year office lease is a big liability on the balance sheet they may not want. So 2 things I think are going to happen. We could see either the co-working model explode, or we're going to cross property types, retail, office, industrial, see shorter term duration leases, which means we could have a very significant impact in the permanent market. Do life companies and CMBS want to do an office building with 5-year leases instead of 10 and 20-year leases, or a life company? Those are the things that forward-looking, connect those dots. Those are the big questions.
Well, the FASB lease accounting changes. It seems like the companies that we talk to say, no, we're not going to let accounting tail wag the dog, whatever you call that, drive the economics, because we still want great build out, we still want great financing of this office space, even an open space WeWork space with the exposed ceilings and all that. It's still very expensive to build out. So and one of the things I heard you say when you spoke at Riga with me, and it's the first time I've heard someone mention this, was that the FASB lease accounting could cause some companies to want shorter leases, and it could cause some companies, in my mind, to maybe think about owning more of their properties if they have a lot of real estate rather than leasing. What might that do to the single tenant net lease investment market? There's a big market of people buying these single tenant properties with long-term leases. Might those leases get shorter? Might some of those properties with the longer leases all of a sudden be a commodity that's hard to find?
Absolutely. I think that is a big question mark. And when you think about that whole net lease market drives on a long-term duration lease. And I think companies may look at owning the asset, and here's why. in the FASB lease accounting situation. So we know that we can calculate very easily the liability of the lease, right? It's an easy cash flow calculation. The asset calculation is a very prescriptive FASB accounting formula that has nothing to do with market rent. So you could greatly miss the true value either when the market's rising or declining and over or understate the asset side of that right to use thing. And that's the thing that hasn't been flushed out at all. And compounding that as well is on the heels of that, parallel to it, is the banks have CECL accounting to deal with, where they have to do life of loan forecasting for their loan loss reserves. So now they've got to pay attention to leases and rollover and year by year reforecast the liability of that loan on that office building or that shopping center. So you could have banks sitting there trying to redesign financial products that say, well, if my reserve allowance goes up, I may have a feature in my loan that causes you to put some more capital up there. So I think, CECL, the loan loss reserve accounting on banks, the lease accounting, none of this stuff is rooted in market rent, in market numbers. That scares me to death.
Yeah. And if you want to know more about the FASB lease accounting, go to commercialrealestateshow.com and just search FASB, and we'll put a link if you're watching, listening to this show on our website or video or podcast. Well, let's ask you about multifamily. Yeah. Multifamily's had a great ride. We're starting to see rents pretty high on these new Class A apartments, and it seems like that's most of what's being built. Some people are thinking in some cities maybe they're overbuilt. You also think about affordability. Can these tenants afford to pay? And if they have to make $80,000 or $100,000 to be able to afford to rent an apartment, how many can do that? What's your outlook for multifamily?
Yeah, so we could give a couple good quotes. Go back to Tom Sawyer, Huck Finn days. The news of my demise has been greatly exaggerated. I think the demise of multifamily has been greatly exaggerated. It is I think the play today is secondary markets and its value add, because that's where you can deliver the affordable feature. A lot of school districts won't let you in major markets or secondary markets let you build new multifamily because they don't want the strain on the school system. So if you can find a good multifamily project, large in size, in a good school district, that's a no-brainer type of play. We're seeing adaptively reuse deals where these things are being bought and completely renovated. It's something like 60 to 70% of replacement cost new. So I think that's one. The secondary markets are very healthy. We waited a long time to see this growth and this recovery emanate out from the primary markets. So whether you go to Colorado Springs, Colorado, or a Cheyenne, Wyoming, or a Tucson, Arizona, or a Nashville, or Ocala, Florida, these markets are doing very well, and they're benefiting. You take a market like in Polk County between Orlando and Tampa, you have Nucor there. It is now one of the major logistics supply center chains. It also is the largest steel manufacturing center in the United States now, in Polk County, Florida. Who would have figured that? So I think secondary markets, value add opportunities. I think the new construction in expensive urban primary markets is going to be challenged. And we're going to have a big conflict go between local government officials, zoning approval people, and the developers to make the numbers work. You're going to have to innovate a product like we're seeing Selig and them doing on the West End here in Atlanta, 11-foot wide products, 600 square feet. And to the lenders out there that don't think that the value is there and you don't have a comp for 11-foot wide, 500 to 600 square foot, $300,000 condo or townhome, go talk to the people at Selig. They have a 200 wait list for 45 units that they're going to deliver immediately. So I think product innovation is going to be used. We're going to see more micro units. We're also seeing people are forgetting that on the NOI growth, in excess of 30% of the lease up in new Class A multifamily is to baby boomers and empty nesters. They maybe have sold the home, they still want to have something in the area, but they want to rent. And they want to be urban and maybe travel in and out of Atlanta, but not have to deal with the traffic, and maybe have another place somewhere else. So I'm not down at all on multifamily. We have good solid rents. We don't have overbuilding occurring at all. I look at the jobs to permits ratio. A normal healthy is in the 5 to 6 range, and we're having like 7 to 8%, 7 to 8 to 1 ratio number. So pay attention to those fundamentals.
That's great. Well, what would you leave our audience with thinking about the economy and commercial real estate moving forward?
Yeah, so I think the big wild card right now is we got to get through the November elections. I think a lot of capital is on hold. I think a lot of capital is trying to accelerate decisions. I know of a couple of clients and people we advise at the university that are trying to accelerate a sale now to take advantage of the low capital gains and the property appreciation before the elections. So I think we got to get through, see whatever happens and how we adapt. I think the things that's happening on the tariffs is very encouraging. This new NAFTA 2 USMCA deal is very encouraging. I think it brings Europe to the table very quickly before the end of the year, and I think China within a year after that. The fundamentals are very much in place with commercial real estate. What I worry about is you got to go back and pay attention to if interest rates rise and cap rates rise, that old IRV cap rate formula, there's only one thing that can mitigate those two effects, and that is you got to have NOI growth. Focus on NOI growth and sensitivity of NOI growth in your deals.
Great. Good information, KC. Thanks for joining us.
Glad to be here. Thanks, Michael.
And if you'd like more information, check out the CCIM Institute at ccim.com. And then we'll have more information at commercialrealestateshow.com. And let us know what you think. We appreciate your comments and sharing the show. And please do reach out to us. And be sure and join us next week. Until then, be sure you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show.